GDP, gross domestic product, is revised down to 2.1% today. It indicates the U.S. economy grew slower in the second quarter than the previous estimate of 2.4%. This suggests that Americans are still buying and selling, but less robustly. Zooming out offers a broader economic perspective. Let's start with the debt. Household debt surged past $17 trillion earlier this year, reaching a record high. Credit card debt hit a new peak, crossing $1 trillion this month, per the Federal Reserve. Fitch downgraded America's credit rating from a AAA to a AA, citing a deterioration in governance. Several banks have recently collapsed. Job reports have been encouraging, indicating job growth and low unemployment. But a closer look at the labor force participation rate paints a nuanced picture, revealing that fewer people are working. This also doesn't account for those taking on extra part-time jobs due to increased living costs. Inflation is down to 3%, still high, but context matters. Compounded inflation over 2 years spiked to 9% last year. To counter this, the Federal Reserve raised interest rates 11 times since March of last year. So prices in some areas are going down, but essentials still expensive, like food, housing. Gas prices are high again, and this is before potential hurricane damage. But now housing affordability is strained, with a 30-year fixed-rate mortgage over 7%. Let's bring in Ed Siddell, CEO and Chief Investment Advisor at EGSI Financial. Ed, welcome back. Also, one more thing I want to point out. A recent CNN poll shows 51% of Americans believe the economy is worsening despite months of, quote, strong economic news. Okay, I'm done now. How is that for an overview? Did I miss anything?
Actually, that was incredible. I couldn't have said it better myself. I mean, you summed it all up. And that's why, it really, if you think about it, this is kind of like a silent recession. No one really wants to talk about it. We all feel it, pain at the pumps, at the grocery store, and it's really affecting everyone. And, the jobs report that's going to come out on Friday, I think that's going to be positive, not as positive as people would hope, but, good news is bad news and vice versa. But what are the types of jobs that we're actually getting? I think we'll see more in the service sector and retail sector, but typically those are second and third jobs. Those aren't the high paying jobs that are career type jobs that have benefits and, going forward. So, I think America is going to continue to struggle. I do believe that the feds are going to raise rates 25 basis points. They've already indicated that they're going to, especially with a lot of the union negotiations going on and wage increases. I think that they're going to have a free pass to raise rates at least one more time, if not two more times.
What about that labor force participation rate? Because the population is aging, right? So fewer people are looking for work. People have retired, maybe. What's the context with that?
Mm-hmm. Yeah, again, it's like anything else. As soon as you've been out of work for a year, you're kind of off the unemployment rolls. All right, so those numbers are skewed. Labor participation. People just aren't going back to work. We've seen a lot with our clients where they're retiring sooner than what they had planned on. So when we're looking at numbers, the jobs numbers, are how real are they? And what effect is it going to have on the economy? I think it's a little more stagnant than what people are really looking at. Those jobs that have been lost this year are the really good ones, high-paying jobs that have the benefits that families really depend on, especially in times like these.
And you think that the Federal Reserve will raise interest rates again? So this will be the 12th time since March of last year. What will that do to the mortgage rates?
I think they've already priced it in. It may be an excuse to bring it up a little bit higher, but right now the federal funds rate is at 5.5%. It'll bring it up to 5.75%. Rates are already over 7%. This is kind of the average of where they. I think the average 30-year mortgage rate is almost 8%. So we're still well below what Americans are used to. But it's painful with everything else. You've got credit card debt. You said it in your opening. You've got credit card debt over $1 trillion. I mean, what this is telling me is that people are spending more money, but they can't meet their bills at the end of the month. So they're having to cover that and hedge their bets by using credit cards.
Yeah.
Now you've got student loans coming due, starting October 1st. So
That's a
I
good
think
point.
it's just going to be a snowball effect.
Yeah, the student loan repayment plan is supposed to start up again after the pandemic. So there's also talk of soft landing when it comes to the economy, a recession. Your take on that?
Yeah, I mean, it's really going to depend on the Feds. If they have this target of 2%, how they came up with that, I don't know. But if they come off of that and say, you know what, it's not going to be 2%, we're going to use a range of between 2 and 3, they're going to lose all credibility. And they're kind of teetering on that right now. So, if they keep pushing for that 2%, we may have to have a couple more rate hikes. Now, what I believe it or not, I think that we'll actually see a rate decrease next summer because of the election cycle. And I also believe that we'll probably see gas prices go down next summer. Again, right? It's the old saying, it's about the election, or it's about the economy.
Right.
So, if we see interest rates go down, we see gas prices go down, pain at the pumps, don't be surprised if you see a good bull market run.
All right, you'll keep an eye on it for us, as you always do, at Siddell, EGIS Financial. Thanks for your time today. Appreciate it.